so that everyone is kind of aware of, on the same page as to what we're speaking about. Okay, so we'll do a quick review about on what capital budgeting is, and then we'll go to the spreadsheet that's up on Blackboard, the spreadsheet template, using our working example, which is also on the slides. Okay. So capital budgeting essentially is deciding on what major capital expenditures to make. So capital in finance we know means long-term. And so a capital expenditure is a long-term expenditure. We know when it comes to the success of a business, okay, making the right capital budgeting decisions is actually the most important thing to do. If you make the right one, you can still get things going in the business if you don't operate the business efficiently. But if you make the wrong capital budgeting decision, then things are finished from the get-go. So it's also important because it involves huge sums of money, usually hundreds of millions of dollars, and also because it generally is irreversible. Once you make the decision and you go out there and you buy a plant or you build a factory or you purchase equipment and so on, it's not easy to reverse that decision. We said if you hire somebody and it doesn't work out, you can do the double Trump and say you're fired, and that's it. It's reversible. But with capital budgeting decisions, they generally are not reversible. So how do we determine then what major investments to make, what capital investments to make essentially? Well, in terms of inputs, okay, and so on, you generally want to coordinate. If you're the finance department, you want to coordinate with a lot of other departments. Typically with the marketing department, you get sales figures and pricing, and you also want to coordinate with the engineering department to get productions and so on. And so all that information essentially will come from there. Once you've got this information from the various departments and everyone is kind of on the same page in terms of what the forecasts are for sales, what the forecasts are for cost figures and so on, for production schedules, then you move to doing the analysis. One thing in finance that we focus on a lot, and this is particularly true with capital budgeting, is we focus on cash flows when you're doing your analysis as opposed to using year-on-year profits. Okay? And for capital budgeting in particular, we focus on then the after-tax cash flows. So these are sort of the two things then. You want to make sure you're not dealing with before-tax cash flows or after-tax cash flows. And when it comes to cash flows, then we have to then be sure that we take into account certain items that will show up on the income statement, but generally don't show up on the statement of cash flows. The big one, of course, is depreciation. There are others, but in this particular example that we'll use, we'll focus only on depreciation. So depreciation, we know, is a non-cash item, but it's an expense that essentially is deducted from income, and so it shows up on the income statement, but when you are calculating the cash flows, you have to add depreciation back in. So what we'll say, of course, is we'll say, well, suppose we have the income statement for 1 year. How do we then add back in depreciation to get the cash flows for that year? And then we can ask ourselves about other things that we might need in order to get what the actual cash flow is for that year. So that's that. When it comes to the analysis itself, you have to ask yourself, what cash flows are relevant to the analysis? Okay? If you are analyzing a particular project, we say only the incremental cash flows that accrue to that project are relevant. And by that we mean, if you don't take this project, your firm or your company, your corporation will have certain cash flows that are already coming from existing assets. If you take this project, then there will be additional cash flows that will come in some cases, and in other cases there will be cash flows that will be deducted from existing operations. All those are incremental, they are caused by the project, and so you have to take them into account. But it is only those cash flows you take into account, the so-called incremental cash flows. And typically then you want to make sure of this. Now, this is a course on modeling, but in the final exam, if you are given a capital budgeting question, some of the questions will have cash flows that are irrelevant, like sunk costs, for instance, are not incremental cash flows. So we'll come to that. So you have to know when you are building your model essentially that some costs you don't include those in the model. That's theory that you are expected to know when sort of building the model here. We've spoken about income versus cash flows. So we use this crude, shall we say, formula here to just say that our cash flows will be our net income plus depreciation. This will be what we call our operating cash flows. And then when it comes to our final cash flows, we'll add in any investments, okay, any investment items. For instance, if you make investments in inventory, okay, that will show up then in the total cash flows for that period. Okay, incremental cash flows, we spoke about this. We're saying some of it can be additional, some can be negative. If, for instance, you have a factory that you could have rented out if you didn't take a project, or a space, a warehouse that you could have rented out because you didn't take the project, or perhaps you are currently renting out because you are. But now that you take the project, you have to use that warehouse for this project. That will end up being a negative cash flow. It will be an expense that will accrue then to this particular project. So there is no, well, there's sort of a list, I guess, that we can put here. And we'll say the cash flows to include, and the relevant cash flows to include are opportunity costs, like this rent I was speaking of, so opportunity costs that will be there. So you include that. Externalities then are if this project is going to have any impact on other parts of the firm. So if for instance, the project is going to cannibalize some parts of the firm. If you are making, say, Honda Civics, and you come up with a project that's going to make some new brand of Honda, some new model, and you expect that by selling this new model, it's going to cannibalize some of the sales of your Honda Civics. This would be an externality then to this project that you have to take into account. If the cannibalism that will come in there and so on. If there are environmental issues where you have to do cleanup, again, take that into account here. Shipping and installation costs. So this is one then that once you get out there in the industry, you'll know. Your depreciation base of all of these here, your depreciation base will include this. So if you are buying turbines, for instance, for some wind farm, then it's not just the cost of the turbines that will form your depreciation base, also the cost of the shipping and the cost of the installation. So it's all in, okay? And that's how much it costs them to do that. So that goes in as part of the investment costs, and this actually goes in as part of your depreciation base. So we'll see what that means in a moment. Inflation, you don't need to include inflation because inflation is picked up in the cost of capital, so it's picked up in the interest rates and so on. And then any incremental financing costs, any borrowing costs, you put that in there. When we say incremental financing costs, we mean any additional fees, aside from just the interest rate you might be paying on all that. If there are additional fees that come into account, you include that. And you don't include them sunk costs. Okay, any questions on capital budgeting? So what we do then with the capital budgeting is we find three sets of cash flows. We have time zero, and we have time Tn. Let's see if we call it. Yeah. We have time Tn here, and then we have time Ti. This is our initial cash flow. And so, George, what will be in this guy here? It will be in the initial cash flow.
The upfront costs.
The upfront cost. So this inside here is the initial investment. That's how much it costs to buy the wind turbines plus shipping and installation. And then any change in net working capital. That is, if you have to, and this is usually the case, if you buy plant and equipment, usually you have to purchase some sort of inventory to support that. It might be spare parts, for instance, that you have to purchase to support the plant and inventory. Okay? So usually there's a certain amount of inventory that will increase at the beginning here. Okay. This over here is the year-over-year or annual cash flows. And the annual cash flows here, the majority of that will be the operating cash flows. Okay. The operating cash flows, your sales minus your costs and so on, add back in depreciation. That will kick in here. If there's any change in the inventory from one year to the next. So here, for instance, your inventory level for your company was at 6 million. Because you now take on this new project, your inventory level jumps to 6.5 million. So now the additional $500,000 worth of inventory will show up at the beginning. If the inventory stays constant like that throughout, then it doesn't impact the annual cash flows. If, however, year over year, your inventory is changing, like we saw, for instance, with our cash budget. If you plan to have inventory that's based on next year's forecasted sales, so your inventory changes, then you will include the year-over-year change in the inventory. So NWC, Simar, what does NWC stand for? Net working capital. And what is it? I keep saying inventory, but on a broader level, what is net working capital? Current assets minus current liabilities, but we focus a lot on just the inventory part of this. If inventory goes up, this is a cash outflow. Inventory comes down, it's a cash inflow. But if your accounts receivables or your accounts payables are going to change, that will also change your net working capital. We'll focus on inventory, however, here. And so this is the last one here. This is the terminal cash flow. And with the terminal cash flow, you have the terminal operating cash flow. So when we put this, I should put OCF, annual operating cash flow. Here is the terminal operating cash flow. Okay. What else happens at the end?
The terminal value.
The terminal value, sometimes called then the salvage value. And so we have the salvage value. And it's at the end, how much can you sell this almost obsolete equipment for? And so often that's zero. And here, we'll just put here, any tax consequences. Not sure if it's spelled right, but I'm going with that anyway. Consequences. It looks okay. What do I mean by tax consequences? There might be some people here who plan to become accountants someday. So tax consequences, what am I speaking about here? It has to do with the salvage value and with how much is left on the books. Okay. So if you sell it, there are three things that can happen. One is you could sell it for more than you bought it. That is, the amount you sell it for is more than your initial investment here. In which case you will have incurred a capital gain. The capital gain will incur then tax consequences. You have to pay taxes on the capital gain. Okay? And so that will be a cash outflow. That's one consequent thing that can happen. Now, normally, of course, because it's being depreciated, the salvage value will be less than the initial cost. Now, it all depends on how much is left on the books. If the salvage value is exactly equal to what's on the books, then you're fine. There are no tax consequences. If the salvage value is less than what's on the books, essentially you experience a tax loss, okay? And you end up being able to recapture some of that back, okay? If the salvage value is more than what's on the books, there's what's called a recapturing of CCA recapture, capital cost allowance recapture, and that essentially is a cash outflow. So we're going to try and keep things simple. You can always fine-tune the model later on or to take into account the tax consequences. We'll keep things simple by generally having this guy here. Okay? Our salvage value equal to our what's left on the books. So UCC stands for the undepreciated cost of capital. It's essentially the value of the book value of the assets that's left. Okay? So we're going to assume you can sell it. Okay, so that's sort of our theory. Our operating cash flow, we've done that. We have our terminal cash flow. And here is I have the U, sounds like the Trump. Speaking of Trump, but it's not just me, it's the whole world. So, so here's our working example. You work for a project called Au Naturel Fertilizer. It's introducing a new product. The new product is a little bit. Okay. It's going to be offered on a 5-year basis. So typically now you're saying that it has these vitamins and so on, and you figure that the lifespan of this new project is about 5 years. After 5 years, there'll be so much competition. You don't think you'll be able to make any more money from this. So, in order to do this here, you have a $150,000 base cost. Shipping and installation will cost another $20,000. You'll need to increase inventory by 6,000. Your research has led you to believe that you can sell 25,000 bags in the first year, and you're thinking there might be a possibility for year-over-year growth, okay? Until it sort of gets to that 5th year, after which competition will set in, but you figure you'll just sell off the equipment and stop right there. Okay? So, how much will you sell off the equipment for? You figure you'll be able to sell it. The market value will be whatever its book value is. You just sell off the equipment. It's $9.50 per bag. That's the price from the marketing department. If you think you can sell it for. Variable costs are $4.50 per bag. Annual fixed costs, your rent and so on, $40,000. And we assume that it's going to be 100% depreciated over the 5-year life of the project using straight line. We'll allow for that to change. We know how to put in depreciation. So we'll first of all build the model using straight line depreciation. But we'll ask ourselves, what's the impact if it was a declining balance depreciation that was in there? We'll take a tax rate of 34%. So this is the information we have, and we want to know if it's worth it to go ahead and spend this money to generate these revenues over the next 5 years. Okay, so this is the sort of spreadsheet that we're working with here. Okay. So the basic template has been set up already. I've started doing this. Now, often it's a good idea if you name ranges or you name cells to give sort of an index of names so that whoever is using the model, when they see the formulas in there and they see, for instance, they see ship install, they get some idea what ship install is, and it's shipping and installation. Okay, so we will, for instance, call this guy here. We said we'll call that equipment. And we'll call this guy we might call okay. How much was the equipment cost? So we've set it up like this. The formatting is okay-ish. I assume that you guys can do better than what's here, right, Graham? It's okay-ish, but we said with these models, this is usually the case. Okay, you want to have an input section, and here we have our capital investment inputs. We have our annual income statement inputs here. We have certain market rates that you will need, And then we have other decision variables that will go in. Okay. We have a discount rate, and I'll ask Leona if she can come up with something else. We want to put something else in here. I'm not sure what will allow Leona to be creative about this. Okay. And then you will have an analytical section, and the analytical section will be, we have it down here. We have our year-over-year cash flow analysis here, and this just takes the income, finds out what the cash flows are, and so on. And finally, we have then the output section, and the output section calculates then certain, well, depending on what method you want to use, right? So for capital budgeting, what are the different methods used to analyze NPV? Okay, so NPV is the premier method, it's the best, net present value. So we'll calculate NPV using the NPV function. What else? The internal rate of return is the next best. The internal rate of return has certain weaknesses. We'll discuss the weaknesses of the internal. There are two key weaknesses it has. And so in finance, we know this, okay? We don't teach it in intro finance. I'm not sure if it's called in 3228, but you often would do they teach in MIR? Okay. You often deal with the modified internal rate of return. And so we'll come to why you want to look at this as opposed to just this. Okay? This takes care of the weaknesses of this guy. And then finally, we'll add this one here, okay? The payback period. Now the payback period is a crappy way to analyze a project. But in industry, they always want to know what the payback period is. So you might as well throw it there. They always want to know, if we spend 150,000, when are we going to get our money back? How long will it take to recover our money? So you just want to throw it in. No matter how much you tell them, and we've been saying this at business schools now for 30 years, and still you get hired by some company and they want to know what the payback period is. You just give up after a while and stop arguing. And so just give it to them, okay? But let them. Now, Excel, of course, can do these, has internal functions to deal with these things, okay, Excel. And so you don't have to worry about building your own internal function. Excel, however, doesn't have an internal function to do this. The book, Timothy Mays, says you can go to his website if you're a student and so on, and he has written a macro that can do it for you that you can add in, and that's fine. But we actually will just build our own thing. It's not that hard to just put in some formulas that will calculate the payback period using the count, if, and index functions and stuff like that. Okay, so we'll just do our own and so on. So that we know what's going on, okay, in our model. Okay, how much is the equipment cost? Let's start putting in some numbers. Okay. 150,000. Shipping and installation was 20,000. Additional inventory, let's label that and call that add-in. And that was 6,000. And the salvage value, we'll put 0 for now, okay? But we'll allow the salvage, we know the salvage value is actually what the UCC is. For straight line depreciation, the nature of straight line depreciation is you start off at the initial amount, okay, C as 0, and over time, this is where you end up. And so it's a straight line, okay? The UCC, the undepreciated cost, just goes straight down to 0. So at the end for straight line, we know this is 0. So we'll just start off here with 0. We'll allow that to change later on. What should we call this, Levi? What should we call the salvage value? We're naming that cell. Salvage, she says, that makes sense. We'll call it salvage. And you might want to put those here, right? Seven. And C8. What this does is it essentially allows your user, instead of having to go into the name manager and figure out what those things mean, because your user may not even know how to go into the name manager. If your user is the chief financial officer, he may have done some Excel back in the day, but if he's in his if he's in his 60s, Excel wasn't really around back in his day. He used to use something called sliding. No, this is that was high technology back in the day. My opinion. So, okay. Our year one demand is 25,000. Is it 2,500 or 25,000 bags? 25,000 bags. We'll allow it to grow at some rate. Right now, we'll put 0. This guy here, we'll just call this G, our growth rate. So, I didn't put the year one demand. Should we give it that a name? What do you think? No? Not necessary? Okay.
Let's go for it.
Let's go for it. Okay, so let's call that demand. Demand 1. Okay, so we'll call this guy demand 1. We have our growth rate G and our unit price. That was $9.50. So this is our price. So C13. Kim, variable costs, what should we call that? Our costs, she says, okay. Fixed cost was 40,000. Okay. Our market rates, we have a depreciation rate. It's right now, we'll put 20%. Okay. 20%. So let's put that in percent terms. And we'll come back to this because I know you guys know how to do this now. So we'll come back to this in a few minutes. And I'll ask you to just put a drop down list here to allow this to change from a 20% straight line depreciation to a 20% declining balance or a 30% declining balance. Okay, so I'll see if you still remember how to do that. Okay, and and we'll see how quickly you can do that, just in case you're asked to do that somewhere in a computer lab on some day at the end of the semester. Our tax rate is 34%. That part is fine. Depreciation, let's just call that CCA. Or should we call it depreciation? Which is more explanatory? Depreciation? CCA?
I like depreciation.
It depends on who's using it. Depreciation is more widely known, you agree? I'll put the R in there just for the heck of it. Okay. And our tax rate. Okay, our decision variables here, this is our discount rate. And later on we'll ask ourselves, where did that come from? Right now we'll put 18%, or we could put 20, but let's put 18 for now. I think that's what it says here. Okay, it doesn't really say. It doesn't say so here. And other, Leona, we were looking for something else that when we say a decision variable, we want to see what else could affect all of this. What have we missed here that could affect this? What do you think? The price of tea in China, it's an interesting number, but it doesn't affect any of this stuff here. Colton, what else did we put? There's one obvious one that comes to mind, but what? George?
The initial cash flow.
Okay, the initial cash flow. We have it up here. We have the 120.
Opportunity cost.
Opportunity cost. Okay, so if we have any additional opportunity cost, we could put that into like I think it's additional rent. Okay, yes, that could go in. There's one I'm thinking of which we're going to end up. I'm just hoping someone will come up with it, but no. And this is all throughout here. We haven't shown what economic life is. We took 20%, but the 20% actually is based on what the economic life is. So right now we know it's 5 years. But suppose it was 6. Suppose you wanted to find out, suppose we could continue to sell for 1 more year. Or suppose we had to stop in 4 years. What will be the impact of that? So when we look at these decision variables, we want to have variables that you would be interested in knowing what the impact would be if that changed. So opportunity cost certainly could go in if we had annual opportunity costs, for instance. But I was thinking for this one here, I was thinking of something like the economic life. And I was thinking of thought. Well, let's format that then to be just a regular number. Okay. So we have all that here. Now, we've set it as year 1 to year 5, but if you allow the economic life to change, then really what you would put in here is you would essentially have an if statement that would allow this to grow for as many years as you have. Okay, so just as we did previously to allow our table to grow, here you would allow your cash flow estimations to grow depending on how many years this was. I know you know how to do that, so for now we'll keep 5 years as fixed, right? Uh, and you could ask yourself later on. So for those of you doing the capital budgeting project, you would have to allow that to change, and that would be Nathan. You guys would have to allow that to change, and Jason. Okay. So our sales, almost everything down here now depends on the inputs here. Okay? And that's the key. You actually want your input section to be where you put stuff in and where you may change stuff. But the analytical section or the analysis section should not have any new information. There shouldn't be any unless it's like Planck's constant, which is or the speed of light or something like that. Then yes, you can put that in because that doesn't really change. Okay, so sales. Our sales is going to be what? How do we calculate sales? For year zero, there's no sales. So let's move down. In year zero here, we're dealing with the cash flow type one. We're just looking at these two, our initial investment amount and our net working capital. So we come down to here and we're saying our operating cash flows for year zero are pretty much just zero. So our change in net working capital, this should actually be let's put the right thing in there. It's not a D, it's more a D. Good. So I just inserted the Greek symbol delta. This is going to be equal to our change in inventory here, additional inventory. So it's negative. You agree with that, Nathan? It's a cash outflow because we're looking for additional inventory increased. And as it turns out, over here, okay, there's something missing here as well. Right, Nick? That is this 6,000 in inventory that we have. Once the project is over, we don't need it anymore. Okay, so here we essentially will go back to the change in net working capital. Our net working capital goes back to its original level. Okay. Our capital expenditure, again, we're going to do minus, we'll take our equipment costs plus our shipping and installation. And so that's our capital expenditure, equipment costs plus shipping and installation. Did that work, Kim? This is assuming you've named them already, right? So did it work, Simon? Okay. Andrew? Okay. So that's there. Now we get to our year one sales. So sales is what's sales? Sales is our demand one times our price. We should put an equal sign. But that should be our sales, right? Our year one demand times the price. So that should be our sales. Our cost of goods sold should be our demand one times what Kim called the VAR cost. variable costs. So that's our cost of goods sold. Let's put that as negative just to be consistent. And so our gross profit then is, should we do a subtotal?
Just on the two of them.
Just add them up. It says, why not? Let's keep it simple. So that's our gross profit minus our fixed costs. And that's minus 40, less our depreciation. Okay, now we have a problem. We don't know what our depreciation should be. Okay? We kind of know. Excel actually has a depreciation function, okay, which they call, there's one that's DB for declining balance, there's SLR for straight line and so on. But it is preferable, okay, at least in my opinion, to come out here and to create what's called a depreciation schedule. So if you go over here, it's already set up for you. Well, let's go through what's happening here. Okay? This is what's called your depreciation schedule, or sometimes called your UCC, your undepreciated cost of capital schedule. Okay? So you start out with what is your depreciable base? What goes on your balance sheet? Okay? We know whenever you spend money, you can expense it or you can capitalize it, right? If you expense it, it goes straight onto the income statement. If you capitalize it, it goes onto the balance sheet. And then over the course of several years, you expense it off by depreciating it or amortizing it, right? So this is our depreciable base. Our shipping costs and our initial investment amount. So that's what we have here. That our depreciable base then, we put some, but we can in fact just put what we did before, equipment cost, right? We can put what we did before, our equipment costs plus our shipping costs. So that's our depreciable base. So we can change that. It's certainly more informative when we see it that way than just seeing C5 and C6, right? Okay. Which means that at the beginning, our UCC starts off being this. This is at the beginning. In year one, at the beginning of year one, our undepreciated cost of capital is what we had at year zero. And that's what we start off with. And then we take off a certain amount of depreciation for year one. And we have what we call our ending, okay, UCC. So how do we figure out what this amount should be here? Well, we put Z3 equal divided by 5. Let's go back and change things and make them a little bit flexible. Right now we put 20%. This 20% actually comes from this guy here, our 5 years. That is, if this was 6 years, this would change. If it was 7 years, this would change and so on. And so we leave this at that, right? And this amount we called our depreciation. And so instead of putting Z3 divided by 5, okay, we'll put essentially Z3 times our depreciation amount. So note that what I've done here, this Z3, I've locked in. If it's straight line, then it's going to be the same amount each year. That's that times 20%. Okay? We'll come back to change this to say, suppose it's a declining balance, in which case, when you find your ending depreciation, next year's amount will be a certain percentage of this and next year's amount and so on. But we'll have to toss in some if statements in that case, and some drop-down boxes. So we can, this amount we can copy here, we know that's the case. And this obviously is going to be equal to this minus that. Okay. That's fine. And so This guy here is simply our ending balance from the last period, and that's fine. And so we copy this across, and we copy this across. And we're kind of good. We have everything we need for our depreciation. So our depreciation or our depreciation schedule is really then this. This is our depreciation schedule here. So that's our depreciation schedule. We have this here, that our net working capital at the end has increased by 6,000, and so it stays constant. So the change in net working capital, okay, stays constant here. At the end, we bring our inventory back down to its initial level, which is 0, and so it goes back here. So this has increased here and has decreased here. So this would be a cash outflow, and this would be a cash inflow when it goes into the cash flow statement. And so these supplemental calculations we just sort of leave to the side. And Georgia, of course, does this quite well. He tends to hide into those. He just put them in as white font so you can't see them. Because no one really wants to know this. You just want the stuff to work properly. It's just out there on the side. So this 6,000 we have here, we might decide to put that in here as well. So instead of additional inventory, we could have put that, but this is fine for now. So less depreciation. So now we take what's going on here. We take our year one amount here, and that is our 34,000. And so this becomes that. Our taxes is going to be equal to our earnings before interest and taxes times our tax rate. Should be negative, so let's put that in. And so our net income is that. We know to get the cash flows, the operating cash flows here, and so now we're dealing with these annual operating cash flows, add back in depreciation. So our depreciation then, what's this guy here? Add back in depreciation. And so this then is our operating cash flow for year one, 67,660. Change in net working capital, we can now go to here. If the change is positive, it's a cash outflow. So we'll go to here. It's 0, and that's fine. Any capital expenditure, we also have that here for our equipment. Okay. So right now we have minus 150. We'll come back here, and actually this amount over here we can put equals to our UCC. So we know, and that's what we said, our salvage value is going to be equal to our, so the equipment you can sell or whatever. I mean, UCC, what is that? What does UCC mean? I've been using that term, assuming that everyone knows what it means. Levi, UCC. What does that term mean? What does it stand for, and what does it mean? Yes, ma'am?
Undepreciated capital cost.
Undepreciated capital cost. So that's what it stands for. What does it mean?
It's your balance.
Okay, your balance. So on the balance sheet, we know you'll have your fixed assets minus depreciation. And what's left then is really this value. Okay? So what you see on the balance sheet after depreciation, after the accumulated depreciation has been taken off. That's what this is. But this is just for this project. Yeah? Okay. There is a complication involved with asset classes and all of that stuff, but that is just fine tuning the model. Okay, so this is in E7. So here, we'll just put 0 for now. And we actually we should put what's here. Let's put 0 in here. I'm not buying any additional equipment. So down here we'll put then equals AA10. Okay. And so we'll calculate our cash flows, and our cash flows are our operating cash flows. What's that? And this is true of here. So this is for year 1. What happens? What's the difference between year 1 and year 2? Well, the only difference right now in this particular model is that in year 2, our demand could have grown by a certain amount, which is here. Okay? Our demand could. So for year 2, for instance, this is our G. We'll say essentially that it could be equal to our year 1 sales, and let's put the whole thing, which is our demand 1, times 1 plus G. And 1 plus G, we want to put it to the power 1. That is, we want to put one formula in here. And so we'll just be picking year 2, year 3. This will allow, if you increase the number of years, then this will change as well. Okay? So we want to pick the 1 from here. Now the way this has been set is that this has gone in as year 1. Okay? And because we typed it in as year 1, we have to just pick the 1 from it, right click, and so we use the right function. Right? So we'll take 1 plus G to the power, and we'll just say right. Okay? And the right function allows you to take any cell, start from the right, and count a certain number of characters from the right, and then just pull that out. Okay? You can have the left function, which starts from the left, takes any number of cells and pulls that out, and you can have the middle function, which starts in the middle and takes any number of functions and takes this much to the left and this much to the right, and so on. So that allows you then to just pull stuff out of cells. Here we just want to pull the 1. So we're taking from this guy, which is the year before, right? And we only want to pull the 1 out. So just 1 character, which is the 1. Now, this is really a clumsy way to do it. I'll be honest. Okay? A better way to do it is actually to have 1, 0, 1 to the actual numerical numbers in here, and then just simply format that to say year 1, even though it's 0. But let's do it just so we know how to use the right function. But what I mean is, it's better to have, for instance, just 0 in here, okay? And then you go in and you format all those cells to say, essentially, say here. Something like that, okay? And you format that. So it's just 0 that's in there, really, but it's formatted to say year 0. In this case, you wouldn't have to worry about doing right. You just take that right away because it's numerical. It's just 0. That's the better way to do it. Okay? Still, having said that, the choice is yours. We know there's always more than one way to skin a cat in Excel, but this is really a clumsy way. I just wanted to demonstrate the use of the right function. Okay, Simon? And now we have that here. We do the same thing with this. So what this allows us, of course, is it means if we change our growth rate from 0% to say 2%, then our demand has changed. We still have to put times price. Okay, so we can copy this over here, that's fine. We just need to include what we did before, times 1 plus G to the power, right.
What did you say your growth rate is?
Right now, I've set it at 2%, okay? So we can see the difference. Now, we're supposed to do risk, risk proper in 2 weeks. But once we finish this and done the NPV calculation, it's almost natural then to start asking the what if questions. So as soon as we finished building this, finding out the NPV and so on, we'll move to our first look at sensitivity analysis. Okay, so we'll do a sensitivity analysis here and we'll use the sensitivity analysis tables. Okay. We'll also build a spider chart. Okay, gross profits, that's fine. We can just copy that over. Our fixed cost, that hasn't changed. Our depreciation. Now, depreciation, of course, was relatively referenced. So it was AA5, and here, of course, it's AA6. Sorry, AB5. So it's taking the right reference from our schedule. Our earnings before interest and taxes, that's fine. Less taxes, that's fine. And the beauty, of course, in using the naming cells is that we don't have to worry about absolute referencing what the tax rate is, since we've used the tax rate. Okay. It's going to pick tax rate. So we don't have to worry about that changing, right? Okay, and so really the rest of it should just work out then sort of the same. Okay, right? And so we can just take that. I think everything has been referenced properly, and then just drag that to your file. NPV. So we have our cash flows, our year 0 cash flows, year 1, year 2, year 3, and so on, year 4. We just want to see this here. We'll just point out what's going on here. At the end, we know that there are 2 things you want to take account of. One is the inventory that you purchase at the beginning. Okay, you sell it off at the end. This has come from our supplemental calculations table, right? Do you have that calculation? Supplemental calculation. It's held here, so it's also referenced there. So that's good. The second thing, of course, is our salvage value here. We spent $170,000 here, and we didn't buy any additional equipment. Then we can sell it off. In this case, since the UCC, its book value is 0, you sell it off at 0, so that's still 0. However, that could change. Okay, and then we calculate NPV. For NPV, we know, of course, NPV starts with year 1. So what this tells us in terms of the NPV function here. So this is all the stuff that we just did just now. Selling off of inventory, initial cash outlays. If your numbers are different from this, it's because you might have changed your growth rate from 0 to 2%. This is for 0% growth. So for our MPV, we use the MPV function, which tells us that we take our rate and our range. We know that the initial year zero cash flow has to be outside MPV function. Has to be outside the MPV function because the MPV function always starts with the first cash flow happening in year one. That's 1 year from now. So we'll do that then over here. We'll take equal MPV. Our rate then is our discount rate. Let's label it. Simar, should we just call it K? So that's C22. Okay. And so our MPV will just take K. And we start with year one's cash flows and we go to year 5. But then we add in this guy here. We put this in outside MPV function. Oh, should it should be D. Outside the MPV function. Okay.
C40, not C.
C40. Okay. And so that's our MPV. Okay. We know what the MPV rule is, and so we have a built-in if statement that's here, which of course you could easily have done yourself. So our if statement simply says, if our MPV is positive, accept the project. If the MPV is negative, right, do not accept. So initially, when we had our MPV as 0, essentially said reject that project, exclamation point. But now it's positive and so on. Okay. The internal rate of return is our IRR function. And the internal rate of return is IRR. In this case, of course, we take everything here and we get the internal rate of return. The internal rate of return usually also asks for an initial guess, but if you put nothing, then they default 0 and then does the opposite. What is the rule for the internal rate of return here? The rule is essentially if this is bigger than K, so we'll put K. Okay. So if it's bigger than K, adopt the project. And so we have essentially next one. Okay. We'll come to the modified IRR and stop there. So let's see what happens with the modified IRR. Let's see the two problems it has. The two problems the internal rate of return function has is one is well, let's start with this one here. Okay, is it assumes that the cash flows are what are called well-behaved. So well-behaved cash flows are cash flows in which you have negative cash flows at the beginning, investment outlays at the beginning, and then later on down the road, money starts to come in. Is anyone else like someone? Is anyone else like someone else coming? Walking by. Or walking by. So this is the problem here, okay? That you have negative cash flows minus CF0, and then you have positive CF1, positive CF2, and so on. This is called well-behaved. There are times, of course, when you get to CF3, you might have to make an additional investment amount. In which case you have negative, positive, negative, and then you might have positive CF4. This is not well-behaved. When this happens, you will have what's called a multiple IRR situation. That's one problem. The second problem is that the IRR assumes what's called a reinvestment assumption. It assumes any cash that's generated here in years 1, 2, 3, and so on, you can reinvest the cash and earn the internal rate of return, which is a really bad assumption to make, because if this is a really good project, it has a really high internal rate of return, and there may not be any other projects out there that you can invest in when those cash flows come in. Okay? So that reinvestment assumption is also a bad assumption. So we'll look at the modified IRR on Wednesday, and then just see how to change things. And I'd ask you to also think of, and you can do this at home, and we'll see what Graham comes up with. Graham, we need to be able to change this depreciation rate like we did when we're dealing with our financial statements. Change it from a 20% straight line to either a 20% CCA rate or 30% CCA rate. Okay? And then just put a drop down box, so we can see the impact. Okay, and that's we'll stop there for today.